Well, I think markets have contended with three levels of uncertainty. The first one is, how does the virus unfold? I think we're getting closer to a forecastability. We all follow the same curves. We're seeing how Italy's performing. We know that the Wuhan lockdown was around close to 7 weeks. So markets are getting comfortable around kind of a forecastable curve. The second level of uncertainty has been the policy response, both in terms of public health measures, how severe what's the extent of the lockdowns that are happening, which sectors of the economy are actually hit and how hard are they hit. Again, markets have a sense of where we are and how long that'll last. And the final element has been the economic policy response. And the last 2 weeks, I think, have been the fastest in world history in terms of what we've seen. It's even for somebody like me who follows this on a day-to-day basis, this is my life, it's been hard to stay on top of all the news flow. But I think markets have looked for three things: size, breadth, and speed of policy response. And on all three, by and large, they have been satisfied. And that's why you can see that I don't want to say we're bottoming out in terms of risk assets, but we're getting close to the kind of the end of the beginning, where markets are finding a footing, because in terms of size, both the monetary response basically ticked all the boxes. In terms of breadth, again, the monetary response, and we can go through that in detail, kind of, again, covered all possible knock-on credit shocks you could imagine. And the speed has been really dramatic. On the fiscal side, though, I say markets still have some concern around whether, particularly around speed, whether you're actually going to be able to channel a lot of the support to households and business balance sheets in time.
Right. Elliot, I want to press you a little bit around timing, because the market has a view that you've got restrictions or lockdowns for about 6 to 8 weeks, and then you weigh up whether the economic stimulus is enough based on that type of economic slowdown. That said, if we take China as a model, what we've seen in that country, technology solutions so businesses can return to usual and you can monitor some of the travel to note where the infection is. Could we be wrong on the timing? Because we heard from the UK over the weekend that we need to think about an impact for 6 months. That's longer than a 6 to 8 week impact on economies. Could there be a bigger hit than the market is anticipating at this point, and perhaps the stimulus is just simply not enough if we're looking at a 6-month time frame?
Absolutely. There's huge scope for market disappointment here. I think the biggest scope for disappointment is that we in the developed economies in Europe and the US do not follow the China trajectory. That's the biggest downside risk we have right now. We saw the numbers in Italy are peaking. We're now assuming that if you extrapolate that curve, Italy can start to begin the exit process from the lockdown 2 to 3 weeks from now. That's when roughly the US, UK, et cetera, will still be hitting peak. So that takes us to late April, early May, when the beginning of the unwinding should start. Anything that pushes that far, far out, 3 months, 6 months, as some of the news headlines suggest, would be a huge disappointment to markets. It would also mean that the policy response is insufficient, because the policy response has been buttressed by the idea that, somehow bridge the crisis to May, and then when we get all these seasonal effects and kind of the treatment improvements, the diagnostic improvements, all of that, we can lessen the social restrictions. And basically markets are pricing for that scenario. So you're right, there's huge scope for disappointment. That's why we're all tracking these curves day to day.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.